Your background is very deal heavy, right? And so, how important will acquisitions be as part of your strategy as CEO to grow this business in the coming years?
It's extremely important, but organic growth is always the main drive, right? So whenever we buy a business, we're looking to make the investment in the sales, in the back office, and also on the service side of the business. We really want to be a service-centric business. And with that said, we're making improvements for those businesses. We're buying new vans. We put a new technology stack in, which really helps us maintain the service business. We look at metrics and we look at where we can make improvements to be better utilized with our technicians and really better geographically service the clients.
Hi, I'm Paul Giannamore. I wanted to welcome our new subscribers to the channel. Historically, Potomac TV has been focused on business and operational information and interviews for residential and commercial services business owners. But after the publication of the Sell-Side M&A Masterclass last month, my LinkedIn inbox has been inundated with a variety of different requests. So Dylan and I will be sitting down filming more extensive M&A masterclasses, both focusing on the sell side as well as the buy side. I intend to talk about the choice of process, delving deep into M&A psychology, as well as extensive buy side practice, approach, and due diligence. For those of you who have not subscribed, you can click below and subscribe to the channel. Furthermore, we've provided a link here in the description where you can get on our email distribution list. And if you do that, you'll receive an email right in your inbox with our latest publications. Feel free to put a comment below on the types of things you want to see. This channel is largely driven by you, the viewer, and what you want to see from us. Again, thanks for joining us here at Potomac TV. Chris, it's great to have you here.
Thanks, Paul. Nice to see you.
So, you recently took on the position of CEO over at Relay, but what were you doing before that?
So my background, start from the beginning. I went to Cornell and had an economics degree and started off actually on Wall Street. So I worked for an investment banking company called Alex Brown, which then became Bankers Trust and then Deutsche Bank. And then I was a vice president at Merrill Lynch in New York City. So after 9/11 happened, I really got interested in the fire and life safety business and had some friends in the business and took a position at Tyco, working under Dennis Kozlowski when Tyco was buying a lot of companies in fire and life safety in New York, and I ran commercial sales there. And then started the New York Fire Alarm Association in 2001. And from there, we started helping write codes during 9/11. A lot of the issues in the Twin Towers was the communication. So we started looking at different codes and came up with distributed antenna systems, and really communication started to become a big part of fire and life safety, which I got very involved in. From there, I got into a company called Convergent Technologies. So that was in 2016 or 2013 with the private equity group KRG when they came in, and I went and ran the Northeast and did a lot of M&A for them. And then we had a couple of exits, and then from there got into another company called Unlimited Technology, where I was a chief operating officer. In February of 2022, I became the CEO of Relay. And basically, I joined with the Riverside company. The Riverside company is a private equity group that had a lot of success in fire and life safety with a company on the West Coast called PSI and a company in the Midwest called Service-Centric. They wanted to replicate that success on the East Coast. So what we did was they bought a company in Boston called American Service Company. Then I came in as a CEO. Then we bought a company in Baltimore called Advanced Fire Protection Systems. And then in December of last year, we bought Metro Fire in New York. So basically what we did is we created 3 regions: a Mid-Atlantic region based out of Baltimore, a Northeast region based out of New York, and a New England region based out of Boston and Quincy. With the full intention of growing that business between Virginia and Maine, kind of staying within that geographical territory. And our business is mostly a service-based business. We are an Edwards dealer, $1 million Edwards dealer in Boston. We're a big sprinkler business in Baltimore, and in New York, we're an inspection business. So we kind of cover a lot of the gamut of the fire and life safety, where we do sprinkler, we do fire detection, we do fire extinguisher, suppression, kitchen hoods, fire extinguisher, emergency lighting, fire doors. So we're kind of like taking a holistic approach and go after a lot of vertical markets that have a lot of needs for fire and life safety. So a lot of hospitals, a lot of housing authorities, a lot of school systems, a lot of hotels, and we're growing the business from here. So We have stabilized our finance department, and we centralized that in New Jersey. So we have a CFO, a controller, an FP&A, accountants there, HR manager, IT director who's sitting over there, Ethan. And really we're built up to scale. So we have quite a bit of acquisition targets right now that we're looking at, and again, between Virginia and Maine.
So your service footprint basically goes from New England down to Virginia.
Correct. Yeah, we will pretty much not go any further south than Virginia.
Okay. And currently, you've got those three distinct those platforms essentially in different areas. Have you harmonized services across those, or are those firms still kind of doing different things?
So it's a good question. As I mentioned, we're mostly a fire detection company up in Boston and a sprinkler company in Baltimore. But in Baltimore, our sprinkler clients want us to do more fire detection, and in Boston, our fire detection clients want us to do more sprinkler and other services. So what we're doing is we're building the product lines and the service lines in each area. Mm-hmm. And each area comes with a lot of different expertise, right? It's all compliant driven and regulatory driven, but we do need to hire around those special line items to be successful, and that's what we're doing. So we're building in each area, we're expanding our product lines and our services.
So this is still a relatively young business. How big is the team now?
Right now, we're about 120 employees, and again, we're growing pretty rapidly right now. So to support the business that we have, and it's more of a service model than an installation model. So we're continuing to hire people in all different trades, but also what we're doing is we set up an apprentice program. So it's very hard to get labor right now. Everyone is having an issue with labor. So we're doing a very good job at starting people right out of college. And I always tell people in the fire and life safety business, it's one of the only industries that you can take somebody out of school, out of high school, and within 5 years, if you get them the right certifications, the right development, you get them product certifications, NICET certifications, they work some overtime. In 5 years, you can have that person make about $100,000 a year or more. And very few industries, you can say that you can do that. So we have apprentice programs where we're taking kids out of vocational schools and we're training them up. We start them up in inspections. We do a lot of inspection, tests, and maintenance. Start in inspections, then we go to service, and then we go from there to programming.
And what's the competitive landscape look like in your geography? Is it pretty dominated by small players?
It's a very fragmented business. There's a lot of generational businesses in our industry. So we see companies that have been in business for 40, 50 years, that have a lot of employees that have a long-term length of service. And we have to be very cognizant of that. So we are in a very competitive environment. There's a lot of private equity that is in our industry. So we see multiples going up, and we see a lot of companies that are looking to exit or to be part or have a financial partner to grow. A lot of these companies get to a certain level or a certain point where they just don't grow geographically, or they don't grow. Don't make investments anymore. It's more of a lifestyle business. So then we come in, and when we look to make acquisitions, we invest around those businesses where we can put extra money into the business, where we do that development, we do the branding, and we help centralize a lot of the back office stuff. And that really helps that build for speed for expanded growth.
I mean, your background is very deal heavy, right? And so how important will acquisitions be as part of your strategy as CEO to grow this business in the coming years?
It's extremely important, but organic growth is always the main drive, right? So whenever we buy a business, we're looking to make the investment in the sales, in the back office, and also on the service side of the business. We really want to be a service-centric business. With that said, we're making improvements for those businesses. We're buying new vans. We put a new technology stack in, which really helps us maintain the service business. We look at metrics, and we look at where we can make improvements to be better utilized with our technicians and really better geographically service the clients.
When you go out and start thinking about making acquisitions, what, in your mind, you look at an acquisition target, let's say XYZ fire protection. But what are important things for you, or what makes that business attractive to you versus something you would look at and say that's not attractive for whatever reasons?
So the main thing that we look at is what's the product mix and the service mix. We definitely want to look at companies that are much more heavily on the service side of the business, a lot of inspection business. Then we look at the product lines and the detection side, as we're an Edwards dealer. We look for companies that maintain that product line. We're looking at geographical presence, and then we look at the team that they have. So we're looking at companies that have a lot of certifications, like NICET certifications, if they have NICET level 4 people, people that are certified to do programming on the detection side. And we look at really the geographical presence and the clients, right? We certainly don't want to look at customers that are very specifically heavy in a certain vertical market, or that have, a concentration in one or two very large customers where there's risk of losing a customer and losing a big portion of the business. So we look at diversity of the clients, of the portfolio, of the vertical markets, of the geography, and then we look at the team that they have.
The targets that you see. Cheers, brother. A lot of the targets that you look at, what do you think is the breakdown between recurring service versus non-recurring? What's the typical mix you tend to see?
So it's a good question. A lot of times we'll look at companies and we're doing quality of earnings, and in that process we'll see that a lot of companies might state a lot higher on the service side than it really is. We look at, retrofit business isn't necessarily service, but other companies might think that it is. So we really look at the inspection side of the business. That's where you're going to see the service. That's where you see, you do the inspections, you write the deficiency reports up, you get the deficiencies, and then you ultimately get the service and maintenance contract and develop long-term relationships with the customers.
I see. And so on a target, for example, what percentage of revenue do you like to see recurring? Is it 20%, 50%, 80%? I mean, obviously the more the better, but I mean,
Sure.
what's an appropriate level?
A majority of the business that we're seeing, we're probably seeing on the service side at least 60%, but we're looking for a little bit higher than that. And that's just service. But then on the really recurring revenue, if you can get anything, closer to that 50% mark, then that's a really good target for us.
I see. It appears that the market's getting more competitive now from an acquisition perspective, as every time we turn around, another financial sponsor gets into this game, and they're even buying. The private equity firms are moving downstream now, right? Like they're literally buying fire protection businesses as platforms that do 10 million in revenue, which was an absurd thought 5 years ago.
Sure.
What do you think that has done to the market over the last 5 years?
Sure. So, as a sell side business that you have, you see a lot of it. We're looking at much higher multiples right now, based on EBITDA, based on a lot of those levers that I mentioned earlier. It's a very competitive environment. Relay is one of several companies in our region that are out there looking proactively to be financial partners of fire and life safety businesses. But the reason why it's such an attractive business is because it's very compliance and regulatory driven. So we're looking at businesses that are pretty recession proof. Whether the economy is really good or really bad, we're still going to have inspections and maintenance, and you're still going to have your fire alarm system. You can't get a CO in a building without a fire alarm system. So we like the fact that it's going to be continually growing. There's a lot of new technologies. If you look around here on the floor of the NFPA, we're going to see a lot of new technologies, a lot of communication technologies that are out there. So it's a growing business. It's not a stagnant business whatsoever.
What about from a geographic perspective, as you continue to grow this business, when you think about your acquisition strategy, do you target specific geographies, or are you just more opportunistic because you got to be where the actual seller is, so to speak?
Yeah, so in our industry, in our business for Relay, we are primarily concentrated between, as I mentioned, the New England, Mid-Atlantic, and Northeast markets, and we're going to kind of stay in that lane. When we look at the business all as a whole, and we see all the businesses out there, we probably have, there's thousands of companies in the fire and life safety business, from small fire extinguisher inspection businesses to large fire detection companies. So, and that's never going to change, because you always see a technician from one company will go and start his own business. There's a very small barrier to entry. You get your licenses and your certifications, and you can be up and running pretty quickly. So we don't see that the market's gonna slow down. I think that there's going to be quite a bit of mergers and acquisitions in this industry for many years to come.
You guys are in very early innings now at Relay. The business was established, you said February 22, is that right?
The first acquisition was in December of 2021, or 2022, yep.
Okay. So, very, very early innings. What does the future look like for you guys? Where are you taking this?
Sure. So the future for us is to continue to expand, continue to make acquisitions throughout the Mid-Atlantic, the New England, and then Northeast markets, and really try to build that service aspect of the business. We're really trying to build our inspection type of the business. We're trying to build the service side where we're doing more maintenance and service contracts, getting away from the large installation jobs where there's a lot of risk. Mostly in the fire and life safety business, when you're doing, for instance, a sprinkler installation, we're normally under a general contractor or some kind of a contractor. So we don't really control the outcome. We don't control getting paid, right? We don't control the margins as much as we do with the service side of the business. And growing that obviously adds a lot of enterprise value to the end result. So for us, we're looking to build a much bigger service side business than we are on the installation side, and really grow all the lines of services in each region. So for Mid-Atlantic and for New York to build more fire detection, more fire extinguisher, for Boston and that area, New England, to try to build more of the sprinkler, more of the fire extinguisher side of the business. And when we look at our acquisition market and our targets, that's where we're going to start to see where we're looking at. We're looking at companies that can really add the value to what we've already created in these markets and what the companies that we acquired have already done. So we are very proud of the businesses that we bought. We're very proud of the customers and the colleagues that we have. And really, what we did is when we bought those three companies, from there we rebranded it. So we rebranded it to Relay, and we put a new technology stack in. So we're really set up for tuck-in acquisitions and really building a brand and a culture. So that's really what we're trying to create now, is a big culture for Relay Fire and Safety to be, the premier fire and life safety company in those three markets.
So from a strategic perspective, you're going to shy away from growing the installation side of the business. I would imagine you have to continue to do it, but that's the installation side's not where you want to focus your efforts.
Yeah, we're always going to have installation. We're always going to have our in-house design. We're always going to be able to do that just because our customers want that. And, but we're not going to go after large new installation jobs. We'll do installation jobs for customers that might be expanding, for instance, a hospital that's building another wing, or a college, a university that has another dormitory going up. And in those situations where there are customer, we will do some installations. But in terms of actually going after brand new installations and bidding on work to general contractors, that's something that we're not interested in.
I want to talk to you a little bit about the private equity model in general. Most PE funds are 10-year close-end limited partnerships. And so you're somewhat on the shot clock, so to speak, when you're involved in a private equity-backed business. And, I guess the average holding period has been compressed in recent years just due to elevated asset prices, but let's call it 5 years, give or take. Does that put you under any sort of undue pressure to scale at a rapid pace? Do you like that?
Yeah, I do like that. And sure, there's a lot of pressure. When you look at the private equity model, typically you're looking at a 5-year hold, right? So the first year and a half that we've had so far was really developing that platform, putting the three companies together, stabilizing those businesses, rebranding it, putting the technology stack in together. And then now building that brand recognition in the marketplace, we're able to start attracting acquisition targets. We've proven that we can successfully integrate acquisitions, and we can successfully grow them organically once we put them into our holding company. So for us, we're probably looking at, like most companies, a 5-year return, 5-year exit. And typically what will happen at that stage is we'll find another financial partner and work with another private equity company, but it's a 5-year plan.
Do sellers have the ability, if you find the right target to buy, if I'm a seller, would I have the opportunity to roll equity into your business?
Yeah, that's a good question. And we have a very, very successful track record of success on exit. So we encourage owners. It's not mandatory, but we encourage owners and founders to roll in equity. Typically, an owner will roll anywhere from 20 to 30% back into the business. It'll be a tax-free investment into the company. And we call that the second bite of the apple, basically. And a lot of times that second bite of the apple could be as big as the first bite, right? Especially for a company like Relay, where we're so early stage into our investment right now, that any owner that would roll back would get quite a bit of return at exit. So we certainly encourage that.
No, I think that's an important point to talk about. So you guys are very early in this investment, which means, contrary to some of your competitors out there that are much more mature businesses, they've been around for a while, they've done tons and tons of acquisitions, so they've already built up substantial value. So if an owner were to roll equity into a long-term competitor,
that's a different situation than rolling equity into Relay because, quite frankly, the stock price is low. It's small, right? It's brand new. It's like buying Amazon in 1996 versus buying Amazon in 2006, right? Do you find that sellers often understand that or don't understand that? Is it something people think about?
I think if you look back, 5 years ago, it would be difficult for the sellers to understand that. But I think because it's such a competitive environment that they do understand that, and that's one of the value creations that we pitch. And when we talk to owners currently, we kind of let them know that, look, we are a very early stage company, and you will get early stage stock, right? So when they do roll over in a company like Relay, they're certainly going to get a bigger bite of that. The second bite of that apple is going to be a lot bigger than one of our competitors that might be closer to exit 4 or 5 years into their process, where we're only a year and a half. So for the next 3 years, it's going to be very exciting for us and certainly for all the founders of businesses that we're going to acquire.
There's thousands and thousands of private equity firms in North America. Riverside's been around for a long time. They have a great track record. What sort of diligence or investigations did you do prior to joining Relay and the Riverside crew?
So being in the fire and life safety business for now 22 years, I've seen a lot of the players that have been in the business, and very few companies have the success that Riverside has in fire and life safety. They have a completely dedicated team to the fire and life safety industry. The operating partners that's on my board sits on the other boards of PSI and Service-Centric. So collectively, we're able to share a lot of ideas and best business practices, which is really, really helpful. And it gives us an advantage that a lot of companies don't have, that especially regional companies. We are mostly a national company when you think about it. The companies are in different funds, but we talk to each other like we're on the same fund and we're all on the same page. So it gives us a very big advantage in the marketplace to have that expertise and the leadership in fire and life safety that most private equity companies don't have. That you might see an opportunity to get into an industry that is attractive because of the compliance and regulatory and non-recession part of the business. But Riverside really has done an amazing job in terms of making the right investments. I think overall there's probably way more than 40 or 50 acquisitions between all three companies at this point. So with that, there's a lot of exposure to a lot of the good things and a lot of the bad things, and we've learned a lot from it. So going forward, we take all of that and we put it into our success.
So are you then personally able to share best practices with those other CEOs?
Oh, absolutely. So we talk all the time. As a matter of fact, we all have the same tech stack. We're constantly changing ideas, constantly looking at acquisitions. In other words, my counterpart in the Midwest gets acquisition opportunities in the East Coast that he shares with me, and vice versa. So we share acquisition opportunities, and we share a lot of internal knowledge around the industry and growth strategies.
And those other two businesses are in predecessor funds to the fund that Relay's in. So it's reasonable to believe that they'll be exiting before you. Those other portfolio companies are in predecessor funds, right?
Correct, yeah. So I'm in what's called Fund 6, and one company's in Fund 4, one's in Fund 5, so one's in Fund 6. So I'm part of a $1.9 billion micro-cap fund.
Chris, you look at a lot of acquisition targets, and God, you've been involved and grown a ton of businesses over the years. When you think about like the family fire protection business out there doing $5 or $10 million in revenue that will ultimately want to exit at some point, what sort of advice could you give owners as far as increasing and building value in their own businesses? What are the things they should focus on?
Sure. Well, first, I would focus on the service side of the business. I would try to get it away from the installation business as much as possible and really build an inspection, testing, and maintenance business. I would really focus on expanding your customer base, not only in vertical markets, expanding vertical market strategies, but also making sure that you don't have a high concentration of your business in a few different customers. I would look at a lot of government contract business that where you can set your rates without doing bid work. So there's a lot of levers that you can pull as a small business owner, and if somebody is a $5 or $10 million business, part of the goal I would think would be for them would be to really have 60-70% of that business comes directly from service, and make it very profitable with having a very diversified vertical market strategy.
And what sort of bottom line, if we think about like EBITDA, for example, what sort of bottom line margins do you think owners should target?
We're looking at companies that have EBITDA from anywhere from 15% to 20%, and obviously the higher service business that you're going to have is going to be the higher margin business. So we put multiples on EBITDA. We don't look at too much recurring revenue. We don't look at the sales numbers as much as we look at the EBITDA. So pretty much me and all of the other people that are in this industry are looking at multiples to EBITDA, and that's where things are trading.
I think sometimes it's hard for companies that have capabilities in installation to avoid that because they see that as big chunky money, right? That's a lot of money that comes in from those jobs. But at the end of the day, it's not recurring at all, and it can disappear overnight. So your advice is to try to avoid that and focus more on that service.
So a lot of companies starting out, they typically get their service business from the installation projects, right? So it's kind of a double-edged sword. Most companies have that installation business that grows the service, but as you get more mature in your business, you want to kind of take all the installation customers that you have, convert them into service, convert them into inspection and test and maintenance, and then build a business from there.
Perfect. Well, Chris, listen, I appreciate you joining me today. It's great to see you down here.
Thank you very much. Nice seeing you,
brother.